Yes, hello students and professionals. It's another great time we meet for these sessions we do. That is for accounting. So my name is CPA Dunochoy. You are normal guys for accounting who does tutorials mostly on financial reporting and advanced financial reporting. So remember that our live Zoom classes are ongoing. The online classes are ongoing. The semester is now halfway, but this is the point now we have entered those main areas which contributes to around 70%, 60% of the exam. So there's still time. As a student, you have time. You can join to my online classes so that we do a wonderful job. That is for the preparations which is required so that you sit for the December exams. So never be left behind. And at the same time, interact with my videos in this platform, that is YouTube. And remember that once you watch those videos, share. And never forget to subscribe and open the notification channel so that whenever I will be uploading any video, you will be able to be notified that CP Edwinochoy has uploaded this and this so that you can watch. So this is a platform which provides, it's almost free work. So why can't you support? So we call it being socially responsible. We are trying to contribute to this provision. So with time, when we come back and say that we need this and this, I think that you would consider that. Anyway, that was not the business of today. For today, I would like to look at financial reporting and analysis paper. That is, to be more specific, August 2022 consolidation question. So that was the question which was tested in our previous sitting. So the August 2022. So we can read that question. So it's a question of Kucha Limited, which owned 70% of Twenda Limited equity share capital since 1st April 2017. The acquisition consideration consisted of cash amounting to shillings 3,600 paid on 1st April 2017. The retained earnings balance of Twenda Limited as at the date of acquisition stood at 870 million and had no other reserves. The draft financial statements for the group companies for the end of 31st March 2022 were as set out below. So we have the statement of profit or loss and other comprehensive incomes for the end of 31st March 2022. So you have the income statement there, you can see those items. And we have the statement of financial position. So my area of concern is the interpretation of the additional information before I present this question on the whiteboard. Number one, the fair value exercise carried out on 1st April 2017 concluded that the carrying amount of Twenda Limited's net assets approximated their fair value, with the exemption of an item of plant and equipment, which had a carrying amount of shillings 100 million below its fair value. As at 1st April 2017, the plant and equipment had a remaining economic useful life of 10 years. Depreciation is charged to cost of sales. So, what about this additional information? There is something we call revaluation in consolidation. So, revaluation of assets. So, what is revaluation? Revaluation is the difference between the fair value of an asset, and its carrying amount. So, you will be told that the fair value was in excess of the carrying amount by a certain figure. So that figure which would be provided, that is the revaluation gain. Or the examiner can say the carrying amount of the relevant asset was below the fair value by a certain amount. That certain amount provided is what we call revaluation gain. Or you can go ahead and provide the fair value of the relevant assets and individually provides the carrying amount. So of which the fair value is obviously higher than the carrying amount. So once you are given the fair value and you are provided with the carrying amount, you take the difference. So the difference between the fair value of the asset and their carrying amount is what we call revaluation. So revaluation gain arises when the fair value is in excess of the carrying amount, or when the carrying amount is below the fair value. So that is what is given in this additional information number 1. So meaning revaluation gain is provided in this additional information number 1, whereby you will debit the PP account, that is property, plant and equipment account, and credit the revaluation reserve account. So with revaluation, they have to go ahead, or as a student, you have to go ahead and compute for depreciation under charge. Because now on this scenario, when there's revaluation gain, that figure of revaluation gain has not been subjected to depreciation. So the figure with the asset revalued with, that figure has not been subjected to depreciation. So you have to determine depreciation under charge. By taking your revaluation gain, you multiply with the depreciation rate, or you take your revaluation gain, you divide with the remaining economic useful life. Like now here, we were provided with 10 years remaining economic useful life. So you take your revaluation gain, you divide with those years. That is how you get your depreciation under charge, based on the revaluation gain. Where are you supposed to adjust your depreciation under charge? So you are supposed to adjust in the retained profit account and at the same time under the asset account. So under the retained earnings account, you debit. Under the property, plant and equipment account, you credit. So that is what you needed to understand in additional information number 1. Additional information number 2, it's the group's policy to measure non-controlling interest at fair value as at the date of acquisition. The fair value of the non-controlling interest in Twende Limited on 1st April 2017 was estimated at 1,370. What is the examiner trying to say? The examiner is saying that there is a non-controlling interest which is measured at fair value. When you see a statement of this kind, my good students, what is supposed to click in your mind is that there is an aspect of goodwill which you need to compute. The parent must compute the goodwill of that subsidiary. So for the parent to compute the goodwill of this subsidiary, it has to use full method. So when the non-controlling interest is measured at its fair value, they are trying to imply that when the student or when the parent will be computing, when the parent will be determining the goodwill of the subsidiary, it has to use the full method. Number 3, Kucha Limited Groups adopts revaluation model to measure its property, plant and equipment as permitted by International Accounting Standard 16. Property, plant and equipment. So revaluation surplus reported by Twende Limited relates to the revaluation conducted on the post-acquisition period. I will show you what is required in Note 3 when I will be doing Twende Limited retained earnings. So all of those net assets, the aspect of computing for the net assets and other things. Number 4, during the year ended 31st March 2022, Twende Limited sold goods worth 200 million to Kucha Limited. Twende Limited reports a gross profit markup of 25% on all it sells. Kucha Limited still had 25% of these goods in its inventory as at 31st March 2022. What are you required to show here? When Twende sold goods to Kucha Limited, he reported a gross profit markup of 25%. But now you need to ask yourself, did Kucha Limited resell all the goods he received from Twende by the end of the year? So on this scenario, you are told that in that last sentence under note 4, that Kucha Limited still had 25% of these goods in its inventory as at 31st March 2022. What does this imply? It means that the goods which Kucha received from Twende, they have not been resold. They are still in the stock. They are in the stock of Kucha, meaning that he never resold all the goods by the end of the year. So out of the goods which are unsold, there is unrealized profit, which already Twende Limited had realized because Kucha paid for those goods. So under group accounting, we say that for the group members, when they transact, one entity is not supposed to have an overstated profit, unlike the other entity. Like now here, Twende Limited's profit is overstated by what Kucha never realized because he never resold all the goods he received from Twende by the end of the year. So we have to determine that unrealized profit on stock, so that we do what? We are adjusting the books of Twende to eliminate profit overstatement. How do you determine unrealized profit on stock? You take the unsold goods times profit margin. Then you adjust in the inventory account and the retained earnings account. The retained earnings account, and at the same time, under the NCI account, the non-controlling interest account, because now this was an upstream sale. This is an upstream sale. It's Twende who had sold goods to Kucha, meaning that the profit is overstated in Twende. So to eliminate that profit in Twende, unrealized profit due to that upstream sale, we are supposed to debit the retained earnings account. We debit the non-controlling interest account. Then we credit the inventory account. So that is when it's an upstream sale. Like now here, it was an upstream sale. Twende Limited selling to Kucha. Note 5. As at 31st March 2022, Twende Limited's record showed a receivable due from Kucha as at, that is of shillings 140, which corresponded with the balances in Kucha Limited's trade payables. So Twende record showed a receivable, that is amount due from the other company, which corresponded with the balances in the payables of Kucha Limited. So meaning that this is an outstanding balance. This is an amount which has not been paid by Kucha to Twende. So the amount was still outstanding by the end of the year. So under group accounting, we always say that when there is outstanding balances which have not been settled by the end of the year between the parent and subsidiaries, these amounts are supposed to be forgone. So you disregard this amount by crediting your receivables account. That is, we credit the group's receivables account and we debit the group payables account. So the group payables account will be debited and the group receivables account will be credited. Number 6, an impairment review conducted on the 31st March 2022 revealed that goodwill arising on acquisition of 20 was impaired by 10%. No impairment loss had been reported in prior years. What does this one show? That once we do our goodwill, we have to subject that goodwill to impairment. And you need to know that impairment is an expense. So the examiner needed us to present or to do a group statement of profit or loss and other comprehensive incomes and the group statement of financial position. So I think now after you are capable, or once you are capable of doing the interpretations of the additional information, it would be very easier for the student, for you student, to do these statements. Because the main thing is all about understanding these additional information. What does they pertain? And at the same time, you get the knowledge of consolidation, that is both consolidating the subsidiaries, associates, and joint ventures. On this scenario, we were having only a subsidiary. The parent had acquired a subsidiary up to 70%. So all of this information is well interpreted under this channel, that is a CPA Do Not Show YouTube channel, for me to make an understanding so that you know what you are required to do. Because the interpretation is not enough. So let's go ahead now and present our question that is in the whiteboard. Now, after we have read the question and we have interpreted the additional information, so let's look at what was required by presenting that question on our whiteboard. So it was all about which are limited, which had acquired 20, so up to 70%. So our financial year, according to this question, was ending on the 1st March 2021. So the financial year was starting on 1st April 2020. So this company, which was called Twende, was acquired on April 2017. So that is April 2017. That is 5 years back. 5 years back. But remember, now you are required to present the statements for the current year only. We are not concerned about the previous years, because those previous years, they have already done their books. We assume that. So we are only required to present our books for this year. So the first requirement you are told to do is the presentation of a group statement of profit and loss and other comprehensive income. So group statement. So the group statement of comprehensive income. Group statement of comprehensive income. Group statement of a profit and loss. Group statement of profit and loss. Profit/loss and other comprehensive income. So for the year ended when? So our financial year was ending on 31st March 2021. So that is when our financial year was ending. So we need to start from the revenue account. or consolidation of revenue, given the revenue account, consolidation of revenue. So remember that the parent was controlling the subsidiary, which is 20, up to 70%. When consolidating, we always take the parent plus the subsidiary. So in this scenario, the parent is 5100 plus the subsidiary 1920. When consolidating the revenue account, you only deduct intergroup sales. That is between that parent and subsidiary. So the intergroup sales which occurred during the current year under consideration. During the current year under consideration. So that is what we are supposed to deduct here. So the sale which occurred is not supposed to be considered as a sale, meaning that it was not supposed to be considered that it's something which generated the revenue for that business. So the intergroup sales, according to the additional information, was 200, and that is according to additional information number 4. During the year ended 31st March 2022, Twenda Limited sold goods worth 200 to Kucha Limited. So that is it. So let's go to the cost of sales. So when we talk about the cost of sales, again, we add the parent plus subsidiary. So 4050 plus 1110. So here you minus intergroup sales. You add the UPS and realize profit on stock. So the same goods of 200, which were sold from Twende to Kucha. So this was the selling price. At a profit margin, so that is according to note 4, when Twende was selling these goods, it included a profit of 25%. That is markup, profit markup. So this is markup. So we have to look for margin. So profit markup given here is all about 25%. That is the same as a quarter. That is what they said in note 4. So, but now this company, Kuja, never resolved which fraction. So remember I explained how you are supposed to arrive at the unrealized profit on stock, because it's based on the goods which the other entity received, which he never resolved by the end of the year. So 200 sold goods to Kuja, but now Kuja never resolved all of the goods by the end of the year. 25% of the goods were still in the inventory. So 25% of the goods. So that is a quarter. So to determine the UPS, unrealized profit on stock on these goods in Kucha, you take unsold goods. You take the unsold goods times profit margin. That's the profit margin. So meaning that the unsold goods is a quarter, that is 25% of the selling price, which is 200 times margin. So we were given markup 20, I'd marked up the goods at 25%. So to change this one to margin, you say a quarter plus 1. So you add the numerator to the denominator. So you add this to 4. You add 1 to 4. So you get 1 over 5. So 1 over 5. So this will be, so if we use our calculator, if we take 200 divided by 20, so that is 10. So UPS is 10. So UPS on closing stock. Because these goods of 25%, these goods of 25% were unsold by Kucha by the end of the year. So that one you are supposed to add. So if this transaction could have occurred in the previous year, by the end of the previous year, let's say 31st March 2020, let's say the same transaction occurred in the end of the previous year. So meaning it could have been a UPS on opening stock in the current year. So UPS on the opening stock, you are supposed to subtract. You are supposed to subtract under the cost of sales, but we don't have that item under this scenario. So the next thing you are supposed to adjust, other than UPS on closing stock and opening stock. So for the closing stock, it was present, we have added. I have explained that if there was UPS on opening stock, we are supposed to subtract, but it's not present. So the next two items you check and you adjust in your cost of sales is concerning revaluation. So you check if there was a revaluation gain. So because due to this revaluation gain, there must be depreciation under charge. There must be depreciation under charge. So I explained that in note 1 there was revaluation. That is due to the difference between the fair value and what? The carrying amount of the relevant assets. So that is what they said in note 1. That the fair value exercise carried out on 1st April 2017 concluded that the carrying amount of 20 limited is net assets approximated their fair value, with the exception of an item of plant and equipment which had a carrying amount of 100 below its fair value. So 100 below its fair value. Below its fair value. Meaning that the fair value was in excess of the carrying amount by the 100. So 100 is a revaluation gain. Then they went ahead to say that there was a remaining economic useful life of 10 years. So 100 is the revaluation. Then for you to determine depreciation under change, you take that 100, you divide with the remaining useful life. So that is, you get 10. So the depreciation under change, with the depreciation under change, you are supposed to add. If there was depreciation over change, that is what you subtract. So depreciation over change, it will be based on a UPFA, unrealized profit on fixed asset. And unrealized profit on fixed asset is due to sale of a fixed asset. It's due to a sale of fixed asset. So whereby you find that one entity is selling a fixed asset to the other entity, but at a profit, then the other entity which received that asset will never resell that asset by the end of the year. So meaning that if the other entity never resold that relevant assets, it means that it never realized the profit which the other entity realized. So for example, if it was K selling to T a fixed asset, K had realized the profit, but now T will not realize that profit because it will never resell that a fixed asset, meaning that the profit of K would be overstated by what T never realized. So that is what first we do by determining unrealized profit on fixed asset in T, so that we eliminate in the books of K by adjusting the property, plant and equipment account and the retained earnings account. So this one, UPFA, you always check the transfer value of the asset, transfer value times profit margin, the value at which the asset was sold times profit margin, transfer value times profit margin. Then after determining that UPFA, you can be able to determine your depreciation over charge based on the UPFA, whereby you will take your UPFA, you multiply with the depreciation rate, or if you are given the remaining economic useful life, you just take your UPFA, you divide. So in this scenario, there is nothing like that. So meaning that we are done with the aspect of consolidating cost of sales. So up to that point, you get your gross profit. So we'll do the computations to get those figures later. So after that, I can see in the question there was a distribution cost. there was a distribution cost. So the distribution cost, you take the parent plus subsidiary, that is 240 plus 210. Then you go to admin, that is administrative. So for the administrative, 480 plus 230. So under administrative, you can decide to add your impairment at this point, or at the same case, you can decide to do what? To present impairment separately on its own. So always present impairment on its own, or on some cases, you can classify impairment under administrative expenses. So, but on my scenario, I always record it separate. So I will introduce impairment loss. So this one will be based on our working, which will be done on the computation we will do for goodwill. Up to this point, we'll say profit before interest and tax. Profit before interest and the tax. So interest is all about finance cost. So checking in my question, was there finance cost? Was there finance cost? Yes, there is finance cost of 85 plus 125. There is that finance cost of 85 plus. So before finance cost, I can see there's an item there called investment income. So I can record that one. Investment income. So for investment income given in this question is 160. Then for the finance cost, so for the finance cost now is all about 85 plus 125. So that up to that point, you can say profit before tax. You can say profit before tax. So we raise income tax. Raise income tax. So parent and subsidiary, 175 plus 125. So profit after tax, we get the profit after tax. So after profit after tax, there was other comprehensive income, which we need to add. Add other comprehensive income. You can see from my question. So for the other comprehensive income, it's all about gain. Gain on property. Gain on property. Gain on property revaluation. So the gain on property, that is a revaluation. So that is a parent and subsidiary, 180 plus 100. That is 280. So up to that point, we have total comprehensive income. Then I will come here and say profit attributable to who? Profit attributable to non-controlling interest, NCI. Then profit attributable to parent. So for the profit attributable to the non-controlling interest, it needs a working. But before we do the two workings which are remaining, that is concerning, I determine impairment and I do the profit attributable to the NCI. Let us do the computations to get the relevant answers for our consolidated items. Like now the first one is 6820. And we have 4980. So 6820 minus answer So that is 1840. That is 1840. 240 plus 210. 450. 450. 480 plus 230. 710. 710. So we cannot get the profit before interest and tax because there is something here missing. That is impairment. So 85 plus 125. This is 210. Then we cannot get this. So 175 plus 125. This is 300. So even if you could have done this way, this statement, they were in need of very few marks. That is, they were in need of around 10 marks or how many marks? So the income statement was 8 marks. So the entries we have done, I think there are more than 8. 1, 2, 3, 4, 5, 6, 7, 8. You have your 8 marks. But now for more understanding, anyway, for us to do all this job, we have to get a space here so that I do goodwill. So that I do my goodwill. So once we do goodwill, we can be able to say that we have the impairment. So that is, so goodwill, on this scenario, you are required to use full method. And I explained why when I was reading the question. I said that when you are provided with a fair value of the non-controlling interest, when the non-controlling interest is stated at a fair value, we always use full method, whereby the goodwill is attributable to the parent and the non-controlling interest. So you start from purchase consideration. Purchase consideration. You start from purchase consideration. So under purchase consideration, they said that at the start of the question, the purchase consideration consisted cash amounting to 3,600. 3,600. Then in the addition information, fair value of NCI was provided in that addition information number 2. It was 1,370. Then you raise share of net assets acquired in the other company, that is in 20. So we have the ordinary share capital. So I would say 70%, 30%. So 70% of the ordinary share capital goes to the parent, 30% goes to the NCI. So you multiply with what? The ordinary share capital in 20. From the statement of financial position under the equity part, it's 3,000. There was no share premium for 20. There was revaluation surplus. So there was a revaluation. So the revaluation, remember that the revaluation we have to use is the one which is given as acquisition date. That is under addition information. So the revaluation we use is the one as acquisition. That is what is given in the addition information number 1, which occurred on 1st April 2017, whereby you were told that the carrying amount was 100 below its fair value. So 70% and the 30% of 100 of the 100. Then after that, we have retained earnings. Again, retained earnings, you use the one as acquisition date, and it's given at the start of the question. Retained earning as acquisition, that is as the date when the subsidiary was acquired. So 70%, 30% of 800 and what? 870. That is at the start of the question. There's a sentence there, they said the retained earnings or balance of 20 as at the date of acquisition stood at 870 and had no other reserves. So after considering those items, because those are the equity components, now let me create a space here. Let me say this is 36 be recorded there, but this is parent. So 70% of 3,000, that is 2,100. 30%, this is 900. So this is 70, and this is 30. 0.7 times 870, 609. What about 30%? 261. So we minus these items. So 3,600 minus 2,100 minus 70 minus 609. So that is 821. 1370 minus 900 minus 30 minus 261. This is 179. So this is our goodwill. So total goodwill being what? So we add 821. So this and this. So this is 1,000. Impairment, you are told it's at 10%. That is according to additional information. Number rust. An impairment review conducted on 31st March 2022 revealed that goodwill arising on acquisition of 20 was impaired by 10%. So 10% times 1,000, that is 100. So yeah, the net goodwill is 900. Net goodwill. So meaning that our impairment here, the impairment to be recorded here is 100, which you could have decided even you add and admin. You classify it under administrative. So if I take 1840 minus 450 minus 710 minus 100 plus 160 minus 210, I'm getting here 530 minus 300, this is 230 plus 280, this is 510, that is 510. So the next working I could do is the one for determining the profit attributable to the minority shareholder, the NCI, the non-controlling interest. Because now when the parent was consolidating this subsidiary, he has been considering the subsidiary at 100%. We have been adding these items of the subsidiary at full values without taking into the aspect of a non-controlling interest. So for the profit attributable to the non-controlling interest, this is what is supposed to be done. Profit attributable to NCI. So for the profit attributable to the NCI, it will be based on the profit after tax. Profit after tax in 20. So this profit after tax in 20 is either overstated or understated. So before we share the 30% of that profit, we have to adjust that profit of 20. So we adjust by deducting what? Unrealized profit on stock, the UPS, if sales upstream. if sales upstream. We raise depreciation. We raise depreciation under change. We add depreciation overcharge. We raise impairment. Impairment will only be considered if full method was used in goodwill. If full method was used in goodwill, of which we use the full method, and this impairment was 100. Why am I adding back depreciation overcharge? Because if you did a depreciation overcharge, your profit was understated. So you need to add back so that you correct that profit understatement. But there was no depreciation overcharge because there was no sale of a fixed asset. So depreciation undercharge is due to revaluation. This was present and we were having it as 10. Since we took the revaluation of 100, we divide with the useful life, we arrived at 10. So because now, why am I subtracting this? Because if you did a depreciation undercharge, your profit was overstated. So you have to minus to bring your profit to its normal state. And for UPS, if it's 20 who sold that goods to the parent, which is Kucha, it means that if the parent never resold all those goods received from 20, it means that the profit of 20 is overstated by what the parent never realized. And the sale was upstream. In our additional information number 4, it's 20 who sold those goods. So meaning that the profit of 20 is overstated by what the parent never realized. And that's unrealized profit on stock was 10. We took unsold goods times unsold goods times the profit margin. So profit after tax in 20 is 120. So we adjust that by deducting UPS if sales upstream, depreciation, undercharge, add back depreciation overcharge, raise impairment loss if we use the full method in goodwill when we were determining this impairment. So the adjusted profit will be, so if you take 120 minus this minus this minus this, it will be 0. So even if I take and say percentage, which is now 30%, because the parent controlled the subsidiary up to 70. So even if I take the 30% now I multiply with the 0, it would be 0. So meaning that is why here the profit attributable to the NCI, I have recorded 0. This one. Then if you take 510 minus 0, you get 510. Now that is profit attributable to the parent. So that is how you were supposed to do the income statement for this question. So the next part we could like to do, which was required by the examiner, is all about the presentation of the statement of financial position. So we write the heading. So as such, our financial year was ending on 31st March 2022. So sometimes group accounting is just the work of doing the posting. Like now here, remember that if I start from non-current assets, I would have to mention about the property, plant and equipment, and I mention about the other items. Then we check on how they were supposed to be consolidated. So the PPE, property, plant and equipment. So the property, plant and equipment, the PPE, the property, plant and equipment. So the PPE, we take the parent plus subsidiary. So that is 53 plus 50 50-50. So what are we supposed to add here? Revaluation. Revaluation was 100 according to note 1. The difference between the fair value of our assets and the carrying amount, as we know from additional information number 1, it was 100. So after this, I said we determine depreciation undercharge, which we minus. So the depreciation undercharge is supposed to be minused. But now here, we don't consider the depreciation undercharge just to be 10, because this 10 is for the year. But now, under the statement of financial position, it's prepared as at the end of the year. Meaning, I have to consider from 1st April 2017 to the current year as at 31st March 2022. So meaning that is for 5 years. So I have to take my 10 times 5. So it would be 50. It would have to be 50. So depreciation undercharge, you raise the cumulative, or the number of years. So revaluation leads to this. Then here you think of unrealized profit on fixed assets, which leads to depreciation overcharge. And this is due to sale of fixed asset. We don't have that in our question. The next item is all about investment. So for investment in subsidiary, we record goodwill. Goodwill, we did our working. It was 900 after subjecting the 1,000 to impairment. But now we need to confirm if our investment given in that statement of financial position is the same as the purchase consideration, which Kuja paid in the acquisition of 20. So in the start of the question, we were told that he paid 3,600. So the purchase consideration, which is supposed to be the same as the investment given in the statement of financial position. So the investment given in that statement of financial position is 4,500. So it's not the same as the purchase consideration he paid. Meaning that the difference, 45 minus 36, is supposed to be considered as other investments. So 4,500 minus 3,600, that is other investments. That will be considered as other investments. So 4,500 minus 36. So that is 900. So after consolidating that, we go to the current assets. So for the current assets, you talk about inventory. So the inventory for the parent is 2840 plus subsidiary, which is 1560. Under this inventory, there is 2 items to be adjusted here. So which are these 2 items? The UPS you minus, you add goods in transit. So the goods in transit is adjusted in 2 areas. So the goods which were in transit, which have not been, let's say K sold some goods to T on credit, but by the end of the year, T has not received the goods. He received them some few days after the end of the year. So remember that our financial year, we were preparing books for, that is 31st March 2022. The books of that year must be adjusted for that goods which had been sold, but they were received some few days after the end of the year. So how do we adjust the goods which were in transit, which were received some few days after the end of the year? We consider inventory account by debiting that goods, you record them by debiting. And remember that since the payment had not been made, because even T had not received them, we credit the payables account. So we credit the payables. That is why I'm saying add goods in transit here. Then when I will be talking about payables, again we will have to add. So the next thing is all about receivable. The receivables. So parent plus subsidiary, that is normal. 2480 plus 1860. Again, we adjust two items here. Again, we adjust two items on these receivables. That is, we forgo the owings. We disregard the amount which were outstanding, which have not been paid by the end of the year. That is between the parent and subsidiary. So how do you disregard? I said the owings. We disregard by doing what? Debiting payables account and a crediting receivables account. So when we debit payables, we minus, and when we credit receivable, we minus. That was given in the additional information number 5. It was, according to additional information number 5, it was 140. And if there was cash in transit, we need to record it by debiting cash or bank account, cash/bank. Then we credit what? Receivables account. So it means that the cash which has been paid, but it was received again some few days after the end of the year. So there was no cash in transit. I could have deducted here. So after receivables, we talk about cash and cash equivalent. So for cash and cash equivalent, it's just the parent plus subsidiary, 1780 plus what? That is 1780 plus 1030. So after cash and cash equivalent, we have the total assets. Then we go to the equities and liability. So for the equities and liabilities, we talk about ordinary share capital. So for the ordinary share capital, you take the figure of the parent only. That is 5,000. For the share premium, you take which figure? Again, for the parent only. That is 1,000. Then after that, there's some items which need some workings here. Like now revaluation, this one doesn't need a working, it's just a small one. So revaluation surplus. So for the revaluation surplus, you take the parent. The parent was 1550. The parent was 1550 plus so the 70% of 700. So the 70% of the subsidiary. So if I take 70% of the subsidiary, that is 490. If I take 1550 plus answer, I get 2040. So this is the figure of the parent plus that of the subsidiary. But for the subsidiary, you have to take 70%. Then after that, there was a retained earnings, which I will do a working later. There was retained earnings, which needs a working. And I will have to introduce non-controlling interest. I have to check what was the capital of the minority shareholders. So these are the ones which needs a bit of workings to be done. And those are the time consuming. But for an exam purpose, they don't have a lot of marks. So student, I think you have to choose wisely when doing them. It's not even a must you do these two in an exam scenario. In an exam scenario, the examiner needs, yes, entries you have done. So why waste your time doing these two, which needs a lot of time, while you can score the all of the marks, which is required from other entries. That is why I always skip the workings first before coming back to do them. But I have to do the easy items, then the workings I do later. So it's all about a strategy which is needed for you to overcome any exam. So anyway, let's continue with the non-current liabilities. So for the non-current liabilities, we have two items: 10% loan notes. So the 10% loan notes, 1,700 plus 1,050. Deferred tax. Deferred tax is all about 740 plus 570. Then we move to the current liabilities. So for the current liabilities, we talk about the payables. So the payables is 2340 plus. So 2340 plus 1,300. Then I said under the payables, for us to disregard the amount which was outstanding between the parent and subsidiary, the 140, we have to credit the receivables and again credit the payables. Then these goods in transit, for us to record them, we have to add under the inventory and we have to increase our payable. So the goods in transit. So if they were present, it's for your revision purpose. That is why I'm recording them. So for your benefit, that is for your benefit. That is why I'm considering them. So after the payables, we talk about the current tax. So the current tax is all about 400 plus 350. So we can be able to add our items. So like now our PPE, property, plant and equipment, will be so this one will be 10,400. Inventory, this is 4,390. Receivables, so this one will be 42. Then this is 2810. Then for the liabilities, 1,700 plus 1050. This is 2750. 740 plus 570. This is 1310. 2340 plus 1300 minus 140. This is 2330. That is the payables. Then this is 750. So, two workings remaining. That is concerning the retained earnings and the non-controlling interest. That is what we are supposed to do. So the non-controlling interest and the retained earnings. So for me to do those two, I have to determine, let me start, let's say, from NCI. But for me to determine the NCI, I have to do the net assets. I have to do the net assets of 20 remittance. I have to do some net assets of 20 remittance. So I will do this. I will have two columns here. So I need the one as acquisition date. I need those net assets as acquisition date. So I will write in short as acquisition date. SEQ means as acquisition date. I need the one as reporting date. And I have the one now, I'm looking for the post-acquisition. Post-acquisition date. So the net assets, it's all about the equity component. So we have ordinary share capital. So as our acquisition date is 3,000, as reporting date is 3,000. So we don't have the post. This is from the statement of financial position. So we have the retained earnings. So the retained earnings, 870 given as at the start of that question. Reporting dates, that is as at the statement of financial position, we have 2530. So if I take 2530 minus 870, so this is 1660 posts as reporting date minus as acquisition date. Then we talk about the revaluation surplus. So the revaluation surplus as reporting date is the one which is present, that is 700. As per the statement of financial position, if I take 700 minus 0, it's supposed to be 700. So remember that we are trying to look for the fair value of identifiable net assets. So under this, there was a fair value uplift as per the revaluation. Fair value uplift as per the revaluation given in addition information number 1. You were told that there was a revaluation, the difference of the fair value and the carrying amount. So it would be 100, that is according to note 1. So this one will be 0. So we have to raise two items here. That is the post-acquisition depreciation. Post-acquisition depreciation. And that is as per the reporting date. So the one which was depreciation undercharge, whereby we took the revaluation divided by 10 times 5 years, we got the 50. So this one will be 50. Then finally, the UPS was 10. That is what we raised. The UPS was 10. So the fair value of identifiable net assets, So the fair value of identifiable net assets will be, 3,000 plus 870 plus 100. So this is 3970. 3,000 plus 2530 plus 700 plus 100 minus 50 minus 10. So this is 6270. 1660 plus 700 minus 50 minus 10. So this is 2300. Remember, this is just a journey towards these workings, retained earnings and non-controlling interest. You can see how the journey is tough. But remember that it's not in an exam scenario, it's not a must you do all of this. What I did already, you have all the marks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So in that statement of financial position, they were in need of only 10 entries. So in this exam, even they were not in need of 10. They were in need of around, it was having how many marks? So this statement of financial position was having 12 marks. The examiner was in need of 6 correct entries. He multiplies by 2. You get the 12. So meaning that without even the 2 workings, you already have all the marks. But now for the purpose of balancing this question, that is why I'm going ahead to do these tough workings. So anyway, let's accomplish this work. So let me create some space here. So because here under assets, there's nothing was missing, I can get the total value of the assets, then we clear that part so that we know our total assets were adding up to what value before we clear that area, so that we use it to determine the other 2 workings. So this one was 23,600. So I will confirm with reliability. So let's finish these 2, then we add the others. We check if we can get 23,600. So put in mind that the assets, total assets is 23,500. Because I want to use this space for the computation of the NCI. So let's do the NCI account. So the NCI, our NCI will be done by taking the NCI as acquisition, NCI as acquisition date. So the NCI as acquisition date is 1370. That is given in the additional information. So to be more specific, that is additional information number 2. Then what you are supposed to add here is the share of post acquisition, share of post acquisition net assets. So the share of post acquisition net assets, you take 30% of this 23. Then less the share of goodwill impaired. You remember our impairment from the goodwill we did? So share of goodwill impaired. So you take 30% of the impairment. Our impairment was 100. So 30% of 2300. So this is 690 and this is 30. So 1370 plus 690 minus 30. So this is 2030. Meaning that here you get 2030. Let us finish with the retained earnings. Let's finish with the retained earnings. So this one was for NCI 2030. So for the retained earnings, again, it's very simple anyway, but difficult because now they are consuming a lot of time. If it was in an exam situation, take my advice serious. Do the one which needs a bit of easier workings, because you will get all the marks based on that. Avoid these 2 items here. They will waste your time, and you have other questions to score. Because already this one, without the 2 workings, you have scored the 20 marks. So for the retained earnings, you talk about that of parent. You talk of that of the parent. So the 100%. So the retained earnings of the parent, the 100% of that from the statement of financial position is 4170. Then for 20, you talk about the share of 200 remitted. 200 remitted is post-acquisition. Post-acquisition retained earnings. So we were having this, but now you have to deduct your depreciation from this 1660. So deduct depreciation and the UPS. So if you take 1660 minus 60, that is 1600. So 70% of that. Then finally you raise the group share. Group share of goodwill impaired. Group share of goodwill impaired. So you take 70% of what? 100. So this is 70. So if I use my calculator, 0.7 of 1600, that is 1120. So if I take 4170 plus 1120 minus 70, so this is 5220. So that is 5220. That is what we record here. So let's add equities and liabilities so that we check if we are getting the same as what we got when we were doing assets. Remember that our total asset value was 23,600. These payables, I can see there's a mistake we made here, because 2340 plus 1300 minus 140, this one is supposed to be 3500. That is what was bringing issues. So 5,000 plus 1,000 plus 2040 plus 5220 plus 2030 plus 2750 plus 1310 plus 3500 plus 750. Yes, we are getting 23,600. So that is total equity and liabilities. So meaning that we are done with this question of consolidation, and that is how you are supposed to do consolidation for subsidiaries. So the parent is supposed to consolidate subsidiaries this way. So meaning that if you go and check another question maybe I have done on how to consolidate associates and joint venture, you will be done with group accounting. Because now here I can see once we finished this, already I even went ahead to mention some few items which you are supposed to adjust, which are not present here. In addition, why can't you attend my online classes? So on these online classes, again, we go ahead to do more questions than what you see in this platform at a very minimal cost. So I appreciate for your time. Share this video to many groups so that any student who is doing accounting can be able to be assisted. So again, never forget to subscribe to this channel, and I expect to see you next time in my online classes. I appreciate for your support. Welcome to the online platform, that is online classes, which we do for the financial reporting and analysis on Wednesday and Thursday, 8 p.m. to 10 p.m. Thank you.